So write H group. So remember, this is continuation. So H group, consolidated statement, consolidated statement of financial position. How's that? How's that like? 30th April. 20? So you copy. We want to save time. We are assuming we are in exam room where time is always not there. In fact, example, immediately you get in, as far as 3 hours. Once you get in, 30 minutes is gone. I don't know what is always the problem. You don't even understand how those hours goes. But when someone goes to the Moscow church, 3 hours, it's like 2 days. Some people still start sleeping. Yeah? But I found 3 hours is like 20 minutes. So to save time, and current assets, PP, intangible what? Intangible assets, investment, keep quiet here in investment. Investment in subsidiary, the investment is what we have invested in our investee companies. What you have invested in the subsidiary should always be replaced with what? With goodwill. What you have invested in the associate and joint venture should be captured here. So you say investment in associates, then joint venture. Associate, then joint venture. Then that is all for non-current assets. That is all for non-current assets. Then current assets. Current assets. Current assets. Current assets. We have inventory, receivables, financial assets, cash and bank. So total assets. Total assets. We are just giving out the layouts. Equity and liabilities. Equity and liabilities. Ordinary what? Ordinary share capital. Then we have share what? Share premium. Then we have revaluation. Reserve. Then we will have retained earnings. Then complete it with NCI. I'm proceeding the other side. So non-controlling interest. Non-controlling interest, you will add the total. So camera. Then non-current liabilities, 10% loan stock, deferred tax, current liabilities, payables, then we have current tax. So total equity and liabilities. So, you know, in exam room, I'm another year kwanza. You can start story. Is it VAT? Huh? We should do it today. So I hope everyone is done copying that. You know, in exam room, we have two people doing exam. We have a student sitting for exam, and we have the student sitting for an exam. So which one do you want to be? Do you want to be a student sitting for an exam or the student sitting for an exam? Which one do you want to be? You want to be the student. So the student is someone who knows story badaya. So the student anafanya kitu kama hii. Provided you are from Alliance, provided you are from Alliance, balance sheet nimewaambia. Once umeona ni 10 marks, make sure you get 10 ticks. Pia then ukiona ni 10, just make sure uko na 5. Sure. Peter. So don't waste your time. very bad things here. The bad things in that thing which can waste your time, instead of utilizing that thing to that time to do segmental, you will use it to do nothing. You do, there are workings here you will do, and to be honest, because there is no time, you will not get them. One, return earnings. Even meaning because there is no time for reasoning. So why are you wasting your time, wasting time? You don't have time even to think. So you will do it, you will not get it, and here it is one tick. So these are very dangerous issues. Also return earnings and CI evaluation. So go for the ones which are sure bet. The ones which are always 3 ticks in any group question, I want to mark them. I've never seen any working on current what? Tax. You are another issue. Deferred tax. Even this one, I know sometimes the step with a group loan, which you have to subtract. But I want the ones which don't require anything to subtract. So these 2, 1, 2 is just a matter of addition. Then when you come this side, the ones which are 3 ticks, ordinary share capital, parent only. So, share premium, parent only. So even this one, financial assets, what are you going to adjust? Even intangible assets, what are you going to adjust? So without struggling, just adding, you will get 1, 2, 3, 4, 5, 6. When you talk 6 over 10, now huko kwingine pia utoke na 5 over 10. See, you are better. So ni vitu watu wana complicate maneno. Mtu ana kwanza yeye akiona swali ya group working one return ndani. Unaipeleka wapi? So I want us to post things which do not require working first. So ordinary share capital, parent only. I explained why we take parent, because for the subsidiary, we normally take our percentage when calculating what? Goodwill. Sorry. The remaining percentage will be taken by non-controlling what? Interest. So in a so in consolidation, we only take for the parent, which is how much? 1,000. 9 ticks. 9 ticks to his pack. Eh? See, so you remember his pack after this hour? See, class was like 6, now like 5. Yeah, so you are shortening the distance between you and this pack. Share premium, the same, parent only. How much? 300. Financial assets, there is nothing to adjust. Just add. What are we adding? 30 plus what? 30 plus 20? 50. You just be smart. Intangible assets, 200 plus 120. That is how much? 320. Rule number 1. Rule 1, anything posted by a student must be marked as either correct or wrong. So there is no way you will be penalized. You'll be penalized and that you left this one blank. No. Whatever you have posted must be done what? Must be marked. So post what you can post. Even if you leave it like this, you have 1, 2, 3, 4 ticks. And then you are okay. Next, the ones I marked first, deferred tax. Deferred tax, you add 100 plus 50. We don't add for subsidiary, for associates and joint ventures. This is how much? Current tax, 20 plus, giving you. See how life has been made easy. Now we go for the ones with the light workings. Light workings, inventory, receivable, cash, payables, those 4. Inventory, you only add the 2, then you check how much was UPI, the unrealized profit. That's what we subtract. Unless the extreme they can go is to tell you that there was goods in what? Transit, which is very rare. That is the farthest they can go. Otherwise, it is always about unrealized what? Profit. So for inventory, just go there, then you subtract the unrealized profit. As simple. So receivables, and by the way, for the record purposes, there is a day I was somewhere. I went to a certain institution, the name withheld, for reputation purposes. Then I was in the lift, and students were in that lift. So I suspected these students are doing financial reporting. So nisikia wakiargue, mwingine namwambia, sisi mwalimu wetu ameanza na groups. Mwingine mwingine anasema, sisi, I think they were being taught by different teachers. So mwingine anasema mwalimu wao ameanza na groups, mwingine anasema mwalimu wao ameanza na consolidation. So ajui watamaliza siku gani. Group ndio consolidation. So msiniambie jina ati sisi sasa tunafanya groups. We are not doing consolidation. Group is the one which is consolidation. So also known as business combination. So that is that. So inventory will be 200 plus 75 minus UPI, the unrealized profit. How much was the unrealized profit? You calculated, I can remember 15. Yes, it was 15. 200 plus 75 minus 15 is 200 and what? 60. Very good. We want to deal with it properly. Let's go to receivables. Receivables, extreme, 2 items. Intergroup balances, and intergroup balances should be balances between parent and subsidiary. Any balance between parent and other associates and then ventures we don't eliminate. So parent and subsidiary. Then 2, if there was cash in what? Transit. Those 2. The one which is common is intergroup balance. Cash in transit, not very much. So you come here, thinking begins after you have added the 2, 300 plus 90. Then we read note number 6. In note number 6, in additional information number 6, the examiner was saying included in trade and other receivables and trade and other payables are the following outstanding balances. Due from S to H. How much? 50. I don't want anything A, J. So the last 2 out. So the balance between S and H was 50. However, there's a note down there. In the books of S, the amount due to H was shown as how much? 40. Because S Limited had sent a check for how much? 10 million. But H had not recorded the check. So that check is the cash in what? Transit. So the correct intergroup balance between the 2 should be what? Should be 40. But upon receipt, how do you adjust for cash in transit? Cash in transit, you add cash purely to the cash book, then you subtract. You wasikudai hiyo pesa. Unajua nakudai na already umelipa. So reduce receivable, what you expect to receive, with the cash in transit, then you will add the cash in transit to cash and bank. That's how we adjust for cash in transit. Reduce the receivable. So the correct balance is 40 between them. But the 10 is cash in transit, which you will add here. How much is that? 390 minus 50 is 3 what? 40. Come to cash. Cash will be 30 plus 20 plus transit. Transit is 10. Transit is 10. Giving you. Is this 30? 150, 40. Okay, thank you. 150, 40. So that is 200. Is 200? Yes, that is 200. Give us there. Correct. Go to payables. The sister of receivables. So in the payables, you add. So we add 250 plus 200 minus the correct intergroup balance. How much? 40. So subtract the correct intergroup balance, which is how much? 40. So that one comes to how much? 410. So that is 410. Don't ask me where is the other 10. 10 is not adjusted. The cash in transit is not adjusted here. So see what will power leave? You go share leave. So already the 10 was net of that. Is our balance sheet coming up? Yes. Are we building it up? Yes. Loan stock, mostly loan stock, there is no working, but here there was intergroup loan stock. Parent invested in a half. You remember? Yes, so you'll adjust that one. So you come here and say loan stock 400 plus 200. But this 200, you remember, the parent invested in a half. You remember? So that is called intergroup loan. So loan from internal sources. Subtract. $600, $500. Correct. Hey, we have been very quiet on non-current assets. Let's visit non-current assets. We have been very cold on them. Let's visit non-current assets. So for non-current assets, PPA in group accounting, two things, revaluation and UPFA. Rarely, most of them, they don't appear at the same time. So just check the one which is appearing there. So now for PPA, we add 1250 plus 800. There was, you remember there's an asset which was sold at a profit of 40. Yes. So subtract, because that 40 is included as part of the cost of that asset. So subtract the 40, then add back the excess what? Depreciation. They were charging excess. When you charge excess, it means you are reducing the value of the assets. Check note 4. So in note 4, they said, on 1st May 2010, remember we are in which year? We are in 2012. We are in 2012. So in 2010, H sold an item of plant for 200 sour. We know we had calculated. So the asset was sold in 2010, May 2010. That was a financial year which was going to April 2011. So then 2011, 2012. So they have charged excess depreciation on the asset for how many years? 2 good years. In the P&L, you saw me concentrating with 888 because profit account is prepared on annual basis. But the asset accumulated depreciation, you keep on adjusting. So I will add back excess depreciation, but for how many years? For 2 years. I'll add excess depreciation for 2 good years. Because the asset was sold to them in 2010. So they charged excess in 2010, 2011, then 2011, 2012. But for P&L, you only check 1 year, 2011, 2012. Yes. So how much is that if you adjust everything? 2026. Goodwill. Goodwill we had already computed. You just check the goodwill of S. Just check for me the goodwill of S. Goodwill of S was 20, but there was an impairment of 5. So you will take 20 minus 5, giving you goodwill of how much? 15. So what is remaining? So the investment, revaluation, retained earnings, and uncontrolling what? Interest. Please, I beg. Kama unataka kusikia maneno yangu usikie. Leave that thing in exam. Hapo. Ndio fanya swali lingine. Ushapita kitambo. Hata uko kwa group ya watu wa awali. Because 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. Hata wewe umeshapita vitu vinatakikana. Anybody now going past that, unless you're looking for what? Are you looking for what? Bora umepita mtihani. Case baadaye. But so here we have to work it out because there are some questions on about that. You calculate the investment in what? In associate. So you should know how it is done so that if it is asked, at least you know what to do. And everybody will be suffering there. So you, but you should not suffer when people are not suffering. Don't come and start working things which you are not being asked. So let's work out this. Let's work out this one here so that I finish with the total asset. So right, have a working. So tumekuja vizuri, but those workings now, itafanya wengine wasikie kulala. Investment in associates. Investment. So these are working in A and J. I want to combine them to save on our time. So write for me here A, J. We want to know, and I want you to take these things in practical sense. Associate is just a small company where you have some small shareholdings. So even if, and you are not allowed to consolidate, and that's what we have been doing. So because we are the minority there. But even if we are minority, I have my contribution. No wonder small it is. Yes. So parents will say, yes, we have 40%, we are the minority. But then after we invested that money, you people have been making what? Profits. So of the profit you made after we invested, we are also entitled to our percentage or share. So you check what share of profit, what profit did they make after you acquired them? Take that percentage, increase your investment. Sure. So you come here and say initial investment. And this one sometimes is required. Initial investment. So check. Note 1. How much was the cost of purchase in A? Are you seeing the 200? So in A, 200, and in J it was how much? 250. Additional information number 1, cost of investment. Then after that, now we will argue. How much did you make after we acquired you? So you come here and say, and post-acquisition. Post-acquisition profits. Post-acquisition profits. A. I'll take 40%. So you post me fresh post, you take the profit today. Today should be the closing. And how do you know the closing? You go to the balance sheet. You know, balance sheet is the one prepared at the end of the year. So check the total accumulated profit in the balance sheet. Subtract the profit which was there when we did what? When we acquired them. So in the balance sheet, how much is the retained earnings of A? Are you seeing the 200? So today, in the balance sheet, they are reporting 200. How much was there when we acquired them in note 1? Note 1 has the acquisitions. When we acquired them in 209, the retained earnings of A was 150. It means these people have made a profit of 50 after acquisition. So that 50 give us 40%, we increase our investment. We are not here to joke. We are serious business. Only 20. In millions. So that is okay. Higher. Then J 50. The same thing which you have done. J and tunafanya practical. Hii ni practical tunafanya. Unaiweka in practical sense. J we invested 250. After acquisition, their current profit is how much? The total profits at the end of the year. Balance sheet is the one prepared at the year end. It was how much? 280. Minus, when we acquired them in note 1, how much was their retained earnings? 120. Get that profit? 160. 50%? 80. How you say? I had to lock the gates for our security purposes. Now we are very secure. So there's this argument again on revaluation. Revaluation is conducted on the values of the assets. When someone is coming to get percentage in your business, she has an evaluation of the assets. And the date of acquisition, and how much is the revaluation of the assets. Then at the end of the year, and if the assets are gaining value, she will also request, because when you charge, so charge back at the values of the assets. So revaluation is the same. You check post-acquisition profits and also post-acquisition what? Revaluation gains, yes. So the same, profit and revaluations, the same. So the same approach you took for profits is the same approach I want you to take for revaluation. 40%, 50%. You take the closings in the balance sheet, you subtract the ones which are there on the date of acquisition. So revaluation in the books of A, 50 minus What minus what? 50 minus? Huh? I hope you're not saying bad things because I'm recording the class and I will share after this. So 50 minus 15 by 40, you get? 14. Then for J, closing revolution is how much? 50 minus 20, 30. 15. Full stop. So now, can you add what these people should claim? Our investment. The first one is 34. And the other one? 3. 45. Is it 234, 345. However, when we were calculating goodwill, so there was impairment. Check. The impairment will reduce whatever you have invested there. So you cannot tell people my investment is this. Now you company has a reputation, what do I make? Customers of the here. So less impairment. Impairment loss. The first one was 8.5. So this was 8.5. Subtract. This was 7.5. Subtract those impairment. Impairment will reduce the value of your investment. So subtract and give me the figures. I don't have space, so I'll write them direct to the balance sheet. From there. Okay. The first one. So for A, I'm being informed here. Don't take it to the far end. Bring it somewhere here. 225 point. And for J, 337.5. Then add the 2. Add this plus this. I'll tell you why I'm doing that. This and this, we bring it here. Sometimes they want to mark them 1-1. Sometimes they just say investment in joint venture associates, then they bring one figure. So you can separate them like that. So add 563. For your information, so we are done with assets. Assets are over. Can you give me total assets? Add back current. Oh, so this is the 29.24 plus this to get the total assets. Add for me all the assets. How much? 37, 71. We are coming on well. Let's go to revaluation. Revaluation. How much is the revaluation for the parent? Parent revaluation is 200. Is a working we need to do, but it's a waste of time. Take 200 plus, you see, for these other companies, it won't work better for me. Let me just do a working. I'll be fixing it in a way which is not right. So I'm working for evaluation. Just have a working for evaluation. Evaluation reserve. So for evaluation reserve, take what? For H, of course, current down in the balance sheet, which you are saying is how much? 200. For the investment companies, you take post-acquisition because the pre-acquisition was utilized in goodwill computation. So you take what came after. So S, so post-acquisition post-acquisition revaluation, S Limited, I'll take 80% of whatever they got after acquisition. So S, take the closing minus pre-acquisition. How much is the closing for S? 50. On acquisition? 20, not one, eh? Yeah, 20. 50 minus 20, 30. 80% of 30, 24. Yes. So add 24. A, J, I'm not going to disturb myself with workings. They are here. We have just done them here. The post-acquisition revaluation. 14 and 15. So no. In this working. This one here. So this one the post-acquisition. Yes. For A, 14. For J, we got 15. So don't waste our time for no reason. 14, 15. We shall add the total. That is the total consolidated. $253. So this is 253. That is what you capture in the consolidated. So revaluation 253. We are remaining with the NCI, then retained earnings. Which one do you want us to work first? Your NCI. Must we always go to workings? Tulipewa fair value. Yes, on acquisition 75, eh? Then we just have to comply. Let's do a working for NCI. But what is the workings and the pricing? So NCI's equity. NCI's equity. NCI's equity. NCI's equity. So check their fair value on acquisition. Tulipewa. So fair value of NCI on acquisition. When we acquired them, their market value was 75. And in quotes, that was their investment, which is their capital on that particular date. So what will come after? What will come after? Watakuwa na adjust. So you will add to them post-acquisition what? Profit. Any profit the company is making after acquisition, minority will take what percentage? 20%. So to get post-acquisition profit of S, instead of S, take 20% of the post-acquisition balance sheet minus acquisition. So balance sheet, how much is the retained earnings of S? Are you seeing the 375? Minus on acquisition, not one. Retained earnings is 5. Give them 20% of that profit. $58. So 58, top up to them, they are smiling. Even revaluation, give them post-acquisition revaluation, 20%, check the closing revaluation minus by them. Revaluation in S is 50. Sure. 50 minus 20. Parent already took 80%. Minority will take 20. 50 minus 20 is 30. 20% of 36. Top up for them. Then once you're done with that, I always want you to have the 3 things in mind. Depreciation, impairment, UPI. So, let me start with the depreciation. So let's depreciate. We add. So it was excess. When you charge excess, you are interfering with the profit is understated. Sure. Yeah. So you add back excess depreciation. But you see, NCI has been there since you acquired the subsidiary. So they must have been affected for how many years? 2 years. So 20% of 8 times 2 years. You must have affected them for 2 clean years. They have been there since the date of acquisition. That one will be 16 times 20%, 3.2. You add. There was impairment. Did NCI participate in the goodwill determination? Yes, it was full method. So it was full. If it is full, NCI participated in goodwill determination. You participate in goodwill determination, you also suffer the impairment thereafter. But if it was partial, then NCI will not be party to impairment. So less impairment, it was full method. Impairment, loss, because it was full. I remember it was 5. Impairment in S was 5. Minority will die with the 20% of that 5. So they will die with how much? 1. Eh? So that one you less. Then UPI, you less on one condition, that it was upstream. S the Walusia parent. That is when the profit will affect NCI. But this was downstream. So in here to Walusia. If you check note 3, H is the one who sold. So this will not affect the profit of the subsidiary. You know, NCI is affected with whatever is affecting the subsidiary. But the seller was H. So the profit of H is the one which was wrong. Which one? Nothing. So that is the current investment of the minority, which they deem to be their capital. Eh? 141.20. Take that one to NCI. Take that one to NCI. 141.20. Kusha, can you use retained earnings as the balancing figure? Then we compute together to confirm. So kindly give me retained earnings as your balancing. The return earnings zimepatikana ni ngapi? 10. It is being reported to be 9. Can we confirm to finish that? Yes. So let's do a confirmation for the retained earnings. Let's do confirmation for the retained earnings. So have their retained earnings, can use whichever form. So retained earnings, I can use it in the statement of changes in equity form. Yes, that will work. So you can do it this way. You say, I can start with retained earnings brought down for H, S, all of them. Then you add consolidated profit for the year, that of the parent. So consolidated profit for the year, parent. Then you subtract dividends. Dividends paid by parent. Now we get an investment income. Then you get retained earnings carried down. As simple as that. So let's post what we have first. There was a problem with the type, I think the typist, this one, dividends are parent. Can you check profit account, parent's dividends? Just check, even you will realize. In the profit account, in the P&L, yeah. Are you seeing dividends paid? In the question, they are showing dividends paid is how much? For parent, yes. 150. But if you take that 350 minus 150, will you get the 265? Can you work? It can't be clear. If you take one profit for the year minus dividends in their workings, if you take that 315 minus 150, it is coming to 265. Are you understanding what I'm saying? Yes. It is coming to that? No. It was a typing error. Actually, the dividend was supposed to be 50. If you take 315 minus 50, will you get that answer? Yes. It should be 50. So dividends for the parent is 50, not 150. It was just a typing mistake. So here, the dividends is 50. So, give me consolidated profit. That one is for profit account, P&L. It is the last item in the P&L, the one we say attributable to the holding company. It was 419 point something. What for 50? See for 419. 419, remember something? 419.9. Yes, the profit for the year attributable to parent. You don't consider it here there. That is 419.5. Correct. Then do permanent is again. Parents, how much is the profit brought down for parents? How much is the retained earnings brought down for the parent company? For the parent company. Retained earnings brought forward tumepewa hapo kwa P&L. So second last. Second last in the P&L. Check your P&L second last. Are you seeing 445? Yes. So it is 445. The only problem I have with that profit is brought forward means from previous year. So, and in the and these are not consolidated books. And in the previous year, there was PP which was sold at UPFA of 40. You remember? It means that profit is not, when you go to consolidation, you should subtract the UPFA of how much? What is affecting parent, because parent is the one who sold it. I know these books are not, these are individual what? Books. So for consolidation, the last year's profit must be adjusted with that and realized. But if the asset was sold this year, it has no impact on the brought down. So, yes. So 445 minus 40. 405. Work somewhere here. Not to the end. 405. Let's go to S. S, make sure you are taking post-acquisition. So 80%. What is the brought down for S? For S brought forward as per the P&L there, 273. But this brought down is brought down when? We are in 2012. S was acquired long time ago in 2010. So in 2010. In 2010, when they were acquired, they had a profit. That one is also included. You know, profit in another accumulated. So the profit on acquisition is also part of this 273. But that profit on acquisition we had already utilized when we were calculating what? Goodwill. So we have to go for post acquisition. So subtract the profit which was there on acquisition of S. It was how much? Not one. Check not one. Retained earnings from S on acquisition was 80 what? 85. Ingekuwa sawa, but now a problem comes in that brought down of S. You know, S is the one to whom their asset was sold at a profit. So S is the one who was charging what? Depreciation, the excess depreciation. Every year they are charging 8. So for their profit brought down in last year, they had charged excess for the first 1 year. By how much? 8. It means their profit was understated by how much? 8. This is excess, the excess depreciation. That profit brought down is being affected by that excess depreciation. Because they are the people to whom the asset was sold to, and they were charging excess depreciation. We can't multiply by 2. By 2 means you are including this year. And you see this is brought down. Brought down means before we commence. So you only work with 8. So this minus this plus this by 80. But you're working with a customer, but you want to say, let's go ahead. 156 point. A 40%. There one maneno mingi. Just take brought down minus pre-acquisition, then it's over. 50%. So just take the brought down minus pre-acquisition like that. Then you are done. Good. So this one is what minus what? 159 minus 150. That is 9 by 40 is 3.6. And this one? 209 minus 120. 209 minus 120. That one I don't know. 44.5. After 50? Yes. 44.5. Can you add all the brought downs? This off, bring here, add this minus this, question. You compare with it is correct with what you gave me. Things are tax. Because how? This one comes to this 609.9, eh? Plus this minus 50. 979. Correct. Unaweza kumteni kuanza kufanya hiyo kitu? Never. Don't do that. Hiyo swali tulipita kitambo before hiyo matokeo unaona hapo natusumbua. Don't waste your time with an issues. Now, there is another question. What we are doing, did I tell you our group is divided? Eh? You know, I talk in so many places, so I don't know where I say. Did I tell you the division of group? Okay, group in this class is this way. There are 1, 2, 3, 4, 5. 5, yes. So 5 is, there is what we call normal consolidation. There is foreign consolidation. There is step consolidation. There is disposal consolidation. Those are 4. Then the 5th is cash flow, consolidated cash flow. Yeah, there are 1, 2, 3, 4, 5. There are 5. So apparently, cash flow in a number yake 20 marks. So this one block, though it's part of group, is consolidated cash flow, not just normal cash flow. Lazima kuwe cash flow iko na subsidiaries, they can even bring in associates. So this one is consolidated cash flow. This one has a number. Then of these 4, they choose 1. Of those 4, they choose 1. Wanaleta 20 marks. So last semester niliona wali choose this one here, foreign. So, and of the 4, the one which is new of the 4 is this step acquisition, this one. The one which is new. Last sitting but 1, they brought this one, disposal. So the one we have been doing is normal. Normal means it is not foreign, it is not step, it is not disposal. So we have not, on what we have been doing just what we were doing in section 3, nothing imekuja new. So the advanced part is foreign, step, and disposal. Hakuna kitu serious kwa foreign. Foreign ni ile head office, sorry, head office. Parent maybe is in Kenya, and the subsidiary is in Uganda. No, Uganda sasa imekuja Uganda. Subsidiary kwa wapi? Zambia, another country. Uganda, we don't want Uganda now. Something like that. So they are reporting in different currencies. So how do you play around with the foreign exchange rates? Then you present them in one currency. So that is foreign. Step, we were having maybe 40% when we started in January. Then before December, somewhere along the way in April, we decided to add another 20%. So how will you consolidate for it? For the period you have not topped up, and for the period you have done what? You have topped up. That is the step acquisition. So step, as the year goes, they keep on adding the shareholdings. So how do you go about it? Disposal, maybe you had 80, along the way you can use it. Then you sell maybe meuza na ukabaki na 30%. So how do you consolidate for it? Then that is it. So nothing very serious into that. So now, these people have been very rigid in examining the normal. They have been quiet actually from this 2012 and the rest. They have been quiet until 2021, last year, yes, September. So we opened September 2021, actually question 1, I remember. September 2021, question 1, but there's something I want us to discuss there. There's something I want us to discuss so that we agree because of time factor. There's something I want us to agree because of time factor. That is H, S, and A. That is it was normal. It does no foreign, it does no step, it does no disposal. It's just the normal. So without wasting time, I have this proposal. Because we have done 2 normal. Bado tuko na safari. Kwenye hii safari inaelekea. Can take you another 3 good weeks, even 4. So I have this request. What I did, the other question, I think this one. I did it only in day. Then what I did in day, then I recorded that class. So evening nikawatumia your solution, na nikawapea the recorded. So mtu amefanya hiyo solution plus recorded akona issue. So tunaongea one on one. Then sasa wao nikawafanyia hii ya 2021, then tuka exchange na wale. So wale nikawapea hiyo recorded plus that. So nyinyi tumefanya hizi mbili. So I was thinking instead of wasting that all time, by the time is not there, if you project. I also propose, because I did it and I recorded, I give you the solution. I have from one of the students there. I give you the solution plus that class which I recorded. Ufuate pole pole. It's just normal class. What is the big difference? If there is issue, hakuna mtu ana namba yangu siko kwa group, and nobody here can say you have ever chatted me na nikanyamaza. You can ask me, how did you get? I know all of them, where they are coming from. You just tell me the setting, then we can respond. Can we be in agreement to that? So that we try to go to the others. So that one I'm going to share immediately after class, because I have it. So I don't know, how should I go about it? Should I share first, then solution if what, am all of them concurrently? No, wacha nitume, then solution nitume kesho. But hata mnasoma hii leo. No, wacha nitume kwanza watu wakae naye. So andika kwa kitabu ndio usisahau. Andika September 2021, the teacher is to share the recorded plus the solution. Yes, September 2021, question 1. Unaona inaandikwa mpaka na red na inakuwa highlighted na yellow. So that one wacha to delay because of time. So allow me to go to foreign. Allow me to go to foreign. But kizungu ile hapo ni hizi tu tunafanya kuna kitu kingine. Utakutana kina UPI wakiwa hapo. And the rest. The only thing which is it has which we have not come across so far, but we come across other questions is evaluation. But evaluation is rising. Unaona UPFA we have been subtracting from PPA evaluation you add. Then if it is being depreciated, you just depreciate and subtract. So, but you will see video unaweza bisha mbele nyuma hivi, sio? Baada ingie. Then ikushinda kabisa utaniuliza. So let me go to IS number 21. IS 21. So we have to be strategic. There are people who are online. You know, there are people who are online who have never come here. Brenda, I've never seen you. Brian, I've never seen you. Bright, you told me you are far. Alice, do come sometimes. Emma, I've never seen you. Yusuf, I've never seen you. Jacqueline. Who else? Those one. Even Joyce, I've never seen you. Susan, Wambui, I've never seen all those people. So what you do, Kina Prudence, those are commoners here. Joyce, yes, I've never seen you. Jocelyn. So you will organize one day, you come. Things are dangerous. You come, we take a photo. You will keep. Emma is saying it's Mombasa. So you organize, you come one day, people take a group photo. Yes, to mitigate anybody who can destroy our student in future that hata CPA kusoma. Anajiwekelea CPA. So you will come, we take a photo, then you go back. Upige picha mpaka na shule. Hii dunia iko na maneno. Sasa to be honest, let's just be honest with ourselves. Wewe sasa ukitishwa receipt. Tuseme labda college umesoma college vitu mingi. Hata ya high school ilikuwa moja. You know college people do here, there you forget. High school was just one. Ukitishwa ya high school form, unaweza pata hiyo kitu. Kuna hizo receipts. Me kwanza nikimaliza fee, you become, you know, when you finish fee, you become very arrogant. You don't care. So I think that is fair. Let me discuss those issues. All right, so let's go to IS 21. At this rate, actually, to be honest, me, I almost forgot my second. There's a name. I almost forgot. So if your name you can even forget, it is normal. You have a name which if you are called, you can't respond very fast. Sasa ujuzi gani ndio utakumbuka? The effect of changes in foreign exchange rates. Foreign exchange rates. So online, let's see where everyone is, because at this rate, from next month, I will want you to start studying in groups also. You get a reading partners or partner. So for example, I can see Emma is in Mombasa. Who else in Mombasa? They can meet. So you meet for group discussion. So anyway, that you go to hapa. So how wengine, especially those who are far, those who are in Nairobi, there is no need. You can come to school and meet friends for discussion. So who else is in Mombasa apart from Emma? Yes, you say you are in Western. Anybody in Western, you can always meet for discussion. Is very important. But it is bad.
The partners from any class. Or
yes, you can take from any class. Wambu is in Limuru. So anybody around Limuru and its environs. You can take in any class, because I assure that we do. Actually, to be very honest, there is no question I do in the day which I don't read in the morning. I do all equal questions. Actually, apart from evening at some part, being your at least, I think I know. I saw the other reading partners wherever you are. Write these notes. How many watu mie hizi notes? See, I said, tangulini nimeanza kudictate. That one, you know, the reason why I don't want to dictate is because of online. Online, you know, network inakuwa na issue. So meditate, mtu hajasikia point 1. Now that's what we do for which point. So that's what I always type for point. So let me share very fast. Foreign, where do I get foreign? Foreign, I know where to get it very fast, and I can share. And actually, I have shared. So that we discuss, tunaenda kwa mahesabu. I will check what I've shared. Oh, no. Let's be smart. I've shared, so what we do, let's discuss without you writing. We go through. We discuss, then you go write. When we meet next, 20 kwa hesabu straight. Then you writing, then you will tell me that you can't finish. Then we go home without discussing. So open, we discuss, then I leave you to go and write. Then when we meet next, 20 kwa hesabu. So it says, and I read, the objective of IS 21 is to prescribe how to include foreign currency transactions and foreign operations in the financial statements of an entity and how to translate such foreign operations. The objective of that standard is to enable, so that is to enable the accountant to know how to account for foreign operations or foreign entities and how to include such foreign transactions in the books of the parent. Key definitions, we have what is called functional currency. Is something you'll be meeting in those questions. They tell you that the functional currency of the subsidiary was this. So what's the functional currency? It is the currency of the primary economic environment in which the entity operates. I don't want to explain until we read presentation so that we see the difference. Presentation currency, it is the currency in which the financial statements are prepared. So in the question, the examiner will be talking of the functional currency of this was this, then the presentation currency. So functional, we have said it is the currency of the primary economic environment from where the entity does what? Operates. Then presentation is the currency which is applied in preparing financial statement. Practical, we have UN in Kenya. So when they are transacting, when they are in Kenya, do they transact in dollars? UNB, so they buy in Kenya shillings. So Kenya shillings is their functional what? Currency. It's the currency of the economic environment from where they are operating. But when UN Kenya is preparing their books, do they prepare books in Kenya shillings? No, they will prepare in USD. So USD is their presentation currency. So what I'm measuring different. So functional currency is the currency of where you are operating from. By the way, South Sudan already they have their own currency. The funny part, they have their currency right now, but they still prepare the books. Though they're using the two in transaction, but they have introduced theirs. But their books are still being prepared in USD. Destiny is operating in Kenya. So the functional currency of Destiny is Kenya shillings and presentation is Kenya what? Shillings. So measure tusonge mbele. Exchange difference is the difference arising from translating a given number of units of one currency into another currency at different exchange rates. At different exchange rates. Yes. So when you translate, you expect to get foreign exchange gain or what? Loss. So foreign exchange difference is the difference arising from translating different what? Currencies. Foreign operation is a subsidiary, associate, joint venture, or a branch whose activities are based in a country other than that of the reporting entity. So foreign operation is that entity which is in the foreign land. For consolidation purposes, the parent company should translate the operations of the foreign entity using the following rates. Hiyo kizungu yote tumesema, hata ukijua hiyo kizungu mpaka wewe kwa mfuko na ujui sasa hii rates, then hakuna kitu unajua kwa hiyo foreign. So those rates is what actually the examiner always checks at. Hiyo ndio wanaangalia. So how do you, because they will give you so wanakupea parent H and S. Parent they'll tell you Kenya shillings, then S wanakuambia maybe Uganda what? Shillings. So you have to translate all the items in the P&L of S to Kenya shillings. You translate where the parent. In fact, kuna makosa examiner wanafanya. They have never been serious. I don't know why. Ama nile kujipenda. I would wish to see an examiner bringing a question whereby the parent is operating in Uganda, another country. France. We want to see a situation whereby the parent is in France and subsidiary is in Kenya. So if subsidiary is in Kenya, then you translate the operations of the subsidiary from Kenya to France. You translate them to where the parent is operating from. So I think because this exam is Kenya-based, so the parent must be in Kenya. So in that case, you have to translate all the items of P&L of S into Kenya shillings, and also the statement of financial statement items to Kenya what? Shillings. So the question will be, which rate will you use to translate? Let's go in that table. So in that table, income and expenses, you use what is called average what? Rate. In all those foreign questions, examiner atuambia, they will tell you average rate is this. Let me do this practically with last sitting, because last sitting they brought foreign. Can you just pick your paper, the front page? I want to check something. So that as they explain, you get to understand what they are saying. Because those rates is what you need to know. The rates is what you need to know. Are you there? Okay. So if you check class 8 to solve this one, check note 5. Just check note 5. The following foreign exchange rates are relevant. Are you seeing down there average for the year? Are you seeing average for the year? Yes. So when you want to translate the P&L, P&L has sio inaona hapa. Sio inaona. Sini. Mwekele mkono hapo nyuma. Aya, so are you seeing the average? So that average rate of 6, that is the rate you will use for all income and all what? Expenses. P&L. So P&L, you P&L we translate at average what? Rate. And the average examiner will give us an exam. That one is surely what I average is this. You tumemaliza. Just hold the paper. Assets and liabilities. You use closing what? Closing rates. So the question is, what is closing rate? Closing rate is the rate prevailing on the date you are required to prepare the balance sheet. So you go to the balance, you go to the required. So like required, just check the required part C. 31st December 2021. So closing rate, hata kuambia hapo kwa rates at hii closing. The only one which you are told is average. Closing, you are guided by the dates. So you check the balance sheet date, 31st December 2021. So which rate was there on 31st December 2021? 4. So for assets and liabilities, unakufa na 4. So then equity and reserves. Equity needs my shares. You know shares and what we have been singing here at the date of what? Acquisition. So those ones you translate using which rate? Historical. So what is historical rate? Historical rate is the rate which was prevailing on the date that subsidiary was done what? Acquired. So it is your duty to check in the question, when was the subsidiary acquired? Check note 1, for example. Additional information number 1. On 1st January, P acquired S. So 1st January 2021. Then you come to the rates. Which rate was prevailing on 1st January? 5. So when you want to translate equity components, ordinary share premium, retained earnings, revaluations on the date of acquisition, you apply what? 5. So income and expenses, average. Assets and liabilities, closing. Closing, you will not be told this is closing. You are guided by the balance sheet what? Date. Then equity and reserves, historical. You will not be told historical, but historical is when the subsidiary was done what? Acquired. Are we good? Yes, tafadhali shika tu rates of them, then you are safe. That is the foreign. God will bring them. Closing rates, we continue with reading. Closing rate is the rate as at the balance sheet date. That's what we have said. Historical rate is the rate when the foreign operation was done what? Acquired. Steps for accounting for foreign operations. You need to translate the statement of profits or loss of the foreign entity. Number 2, translate the statement of financial position. Number 3, determine foreign exchange what? Reserve arising on translation. In which case the foreign exchange reserve can be a gain or it can be what? A loss. Then determine, translate and retranslate goodwill arising on acquisition. Determine means you compute goodwill. Translate means you translate it to what to say Kenya shillings. Kenya shillings. Translate it to Kenya shillings on acquisition. Then retranslate it to date when we are closing the books. You know goodwill. We all know that goodwill is computed on the date of acquisition. So compute it in that foreign, translate it to Kenya shillings on the date of acquisition, retranslate it to the reporting dates. Yes. Then prepare consolidated financial statements using the presentation currency of the parent company. Those are the steps. So that is it. So what you will do, write for me those notes. Then we make illustration to answer your question 1, your April 2022. So that will be our first question. So final year, then that will be good. That one can give us mileage next time. Thank you. So we meet tomorrow at 8:30. Kesho tuko deferred tax. Yes. So present yourself early for that fellowship. Maisha yenu iko kali sana, sio? I thank you so much. Online you can check out. I'll send you the recorded class for that other one and even this one. So don't confuse. Actually, hey, I'm sending you how many classes? 1, 2, 1, 2, 3. I'm sending 3. 1 for that question. 2, there was early morning for this question. And you connect the 2 of them. So that early morning today, early morning this one, then that one. Yes. Thank you.